it's a real pleasure to be here. Thank you so much for taking time out of your day. Incredible view. I've certainly never been here. Hopefully it's as fresh as some of you, and so therefore a bit of an experience as well. I really resonated with George and Sarah's presentation there because we see so many of these dynamics in the UK, and that's why we saw Australia as a huge opportunity for CrowdProperty and what we're trying to do to drive ultimately house building, which balances the supply and demand of real estate, which manages pricing as well. And that's fundamentally important. But we focus on an area that's very underserved, and in particular in small and medium-sized developments. And we founded this business, and I'll talk a bit more about it in a moment, fundamentally because we found it a pain to raise finance for our property projects. So 3 co-founders sat around the table, kitchen table, as every good startup should come from, and said, well, look, surely there's a better solution than the traditional sources of finance, the banks that were supplying into the market in the UK, and the dynamics that we see exactly here as well. And it's always really important, so when you're looking at different markets, to really understand, well, are those same drivers there, right? And hopefully I'll bring to life about why that's important also, exactly the affordability issues and the housing challenges that both the UK market face, and also we see in the Australian market. And so what are we going to talk through today? Well, first and foremost, what's accentuating that affordability issue, okay, that we're looking at and that we're addressing? We cannot address those many levers that were outlined by George and Sarah, but we are focusing on one particular one. So how are we solving that for property developers? And so that's the pain we focused on. Okay, poor provision of finance to small property developers. But there was another angle as well, a secondary pain that we worked out we could solve with a really interesting technology-enabled model, which was unlocking diversified access for investors into what is kind of a lumpy asset class. Right? And that's interesting because that presents opportunity for investors as well. And then we'll wrap up with some Q&A. Just very briefly on my background. I was in strategy consulting for many years and advised lots of sort of very well-known brands here, certainly in the UK. Some of them might be recognisable here as well. But a lot in the consumer sector, okay? And I think that's really important because we're taking the attitude of an absolute focus on the customer and the needs of the customer. And I would assert, and I apologise if this goes close to some of you in this room, I would assert that financial services is not the best customer-facing industry in the world. Controversial, I know, for some of you, so apologies. But bringing a consumer lens on that, okay, is how we're thinking. Okay, and that's very purposeful. And then secondly is the technology lens. And I personally saw huge potential. I've been investing in real estate in the UK since 2002. I saw huge potential for the role that technology could play in the world's largest asset class, that is a physical asset class, that needs to be managed, assessed, bought, sold, constructed, etc., right, in a physical way. And that's a very human-intensive, human resource-intensive activity. So technology must be able to do lots more. And actually, it's very interesting. So PropTech, the shortening of property technology, a McKinsey report recently said, sort of likened the adoption of technology in the real estate sector to the adoption of technology in agriculture. Right? And I've said that definitely in the wrong room before of big real estate people. But it's true, and I'm really close to the heart of this. I'm involved in a venture capital fund that focuses on investing in PropTech businesses. And that is really the core of how we're thinking. Right? How do we bring technology efficiency, okay, but you cannot algorithm property development lending. So we leverage a load of technology, okay, and then a load of expertise, and marry those two together to provide that customer-focused service. So as I mentioned, every business is great to start with a pain, and one that you experience yourself, and one that you know the angle to solve. You're the customer as well. You know what your pains And I'm going to zoom right out for a second, okay, and look at the macro picture as we did with George and Sarah, okay. These are UK numbers, but we see similarities with the Australian market as well. Okay. And there's one thing that the UK is spectacularly good at, which is clearly not cricket, is that we are spectacularly good at building 200,000 homes a year. The problem is we need 340,000 homes a year, and it's remarkably consistent. And if you're not addressing that fundamental supply, okay, you're driving that supply and demand imbalance, you're driving prices up, and there's a problem in the market. And sure enough, so looking at a couple of years, so in 2008, the UK built 200,000 homes. In 2017, the UK built pretty much 200,000 homes. So that's not a great story, but the story is when you cut that into segments, okay? I'm not sure if you can see it at the back there, but this is basically broken out by small builders, medium-sized builders, and large builders. So the provision of supply, who is building this stock? Right? And actually, this is really fundamentally important, okay? Because in 2008, very purposely picked 2008, something pretty substantial happened at the end of 2008, but didn't really affect housing delivery in that year. But 30% of that house building was by small builders. Really, really important. Why? Why? Well, this is not the ideal window to look out of and see lots of infill sites. But traditionally, you can look out of any window, right? And you can see opportunities for infill, for conversion, for extension, for refurbishment, plentiful, almost infinite opportunity, okay, to put housing wherever, right? And that helps densification of cities, lessening the burden on infrastructure as it sprawls out. So it's huge importance that small developers play in house building markets, because those things are not economic for large builders to build. So by 2017, that 30% of housing supply from small builders fell off a cliff to 10%. Fortunately, large builders supplied more, but they're eating into that scarce resource, which is large sites that it's economically feasible to develop and produce housing. And that's a problem, okay, because they're not always going to be able to catch us up. And especially if you think, well, how we actually have to build 340,000. Okay? The only way you unlock that is by empowering small and medium-sized developers to build more, to exploit those opportunities, those almost infinite opportunities. So, as a good former strategy consultant, I might look at that and say, well, that looks like a total dog of a market. Why would you ever go into helping small builders? Well, actually, you look at it a different way and you say, well, what's the barrier? What's the problem? Okay, is that a constraint? If you unlock that problem, do you drive that back up? Okay. And we felt that ourselves because we wanted to build sites. We wanted to build houses. We were building anywhere between 2, 5, 10, 20, that kind of scale. And that's the rump of that small builder segment. Okay? People putting that number of housing into the market. And then we went out, so we've seen it at the top level. We understood it ourselves. So to prove we weren't mad, we went and asked a load of small developers what would unlock them to build more homes. So a big survey, probably one of the largest that's ever been done in a segment because it's so hard to access and identify who, etc. We asked them, so what will enable you to build more homes? Okay. And this comes to the levers that George and Sarah very much play towards here. And we see in fourth place, improved tax policies. In third place, improved planning system. Again, this is what the small builders are saying in the UK, but we're seeing exactly these insights from the Australian market as well. So those two levers, tax and planning, okay, they are big government levers, and the government in both countries has been pulling those, especially through the pandemic, to maintain the construction levels. Number two, improving economy, and that's a collective effort. And of course, I wouldn't be presenting this data if number one wasn't improved sources of finance, but how stark it is. Okay. This is the big unlock for small developers. So that's what we set out to address. And we went further in that research and ran focus group after focus group after focus group with developers to really get under the skin of what were the pains. And they were plentiful. We sit down with them, we ask them open questions. Tell us about your experience with traditional sources of finance. And then a lot of swearing happens. Then some publishable gold comes out. And I'm not going to go through these. Okay? But the point is that once you collect this, you see the pain. You then organize that and you build a proposition around that customer. Right? Not asserting a proposition that fits a bank balance sheet, investment profile, etc. It's thinking about what's the product that unlocks the potential of small developers. So took that, did exactly that, and built this as property finance by property people. And that stands alone. That doesn't say technology, but there's a hell of a lot of tech that sits underneath that to enable us to deliver that, to enable us to support the experts in our business that are out there liaising with developers and talking their language and proving themselves that they're a better source of finance. And it stands uniquely in the market. Okay? Nobody goes to market like that, and it really resonates. So what do we conclude? What do we drive out of our business, our systems, our people, etc.? Well, speed, ease, certainty, expertise, and transparency of finance, because they were the most important things that developers want. We do that with technology underpinning the whole thing, and then expertise to really work with developers as a partner. So we built the proposition that can serve developers better. Right? And that's behind the growth in the UK, and that's behind the potential in the Australian market as well. But the really interesting thing then is there was another pain that we could solve. And we turned our attention to, well, if we serve developers better, the best developers and the best loans will want to be funded by us. Well, that's really interesting then on the investment side and the capital side, because if you get that right, then the risk profile of that positive selection of really great developers that are building great stuff and unlocking that potential, that produces a really interesting asset class. And so that's what we looked into. We looked at the marketplace lending model that was coming out of US, Europe, UK, businesses like Lending Club, Funding Circle, Zopa, fractionalizing these lending opportunities and passing them out to individuals rather than just institutions. And we sort of looked into it and we thought, well, why does that work? Why does that actually stack up? Why is that an interesting proposition? And again, I'm going to go right back top level. And there was a McKinsey report a few years ago that looked into comparing marketplace lending with bank lending and the economics thereof in the US. It's quite progressed in the US. And this was their conclusion. So let's take ourselves out of property for a second and say, right, a manufacturing business in the US, and this is US market, but all reflective of a lot of the banking costs, platform costs in other markets as well. So let's take ourselves out and say there's a manufacturer that makes widgets and they're very good at it and it's a good market and they want to build an extra line, right, to produce more widgets. I don't know if widgets is a term that's used in Australia, it's just a sort of a thing.
It's been used for eons.
Right, good, okay, good. And so that manufacturing business may go to a bank and say, look, I want to borrow some funds. And that may be priced illustratively, and illustratively in the McKinsey report, they did a good study on this. They said, right, well, that's 10% interest. And these are aggregates, but they did do a thorough study. Now, the interesting thing is, you look beneath that, where does that interest rate get allocated into? And 7 percentage points of that 10% interest rate went into the fixed costs behind that business. then to market economy, 2% of that went into their profits, and that left savings returns within those banks of next to nothing. Now, clearly, that is a bank savings account. Okay, theoretically, capital is not at risk. So theoretically, but it's proven over many years. So there's a different model. The model is to directly lend, okay, and do that more efficiently. And that is the lending club model in the US. So they're lending to small businesses. And what they have is a much leaner platform, tech-enabled, not the heavy fixed cost base of large offices, large staff bases, legacy IT systems, etc., but lean purpose-built systems. It has a lower cost base, they have a lower overall profit requirements, and therefore a greater return to investors, a significantly greater return to investors. Now, in actual fact, the way that's structured is that capital is at risk, okay, but that number is a post-expected losses return. Right? Okay. So there's a different asset class in that, but there's a different level of return. So this was interesting. This was interesting to us. And so what we felt was, okay, where's the inefficiency in property? And property finance in particular. And actually really interesting. And there's lots of ways that the origin, at the end of the day, every dollar is owned by an individual. Okay? So how does that get to a developer? And there are many ways that this happens, right? This is just one, and this is a bit of UK terminology, right? So let's say my mother lends through CrowdProperty, so does my wife, so does my mother-in-law. That's why I've got to do a damn good job. But my mother might have $1 here, and a decade or two ago, she would have gone to an advisor who might say, well, put that £1, that $1 into a fund, a general fund. That general fund might say, actually, put that, let's find a property specialist fund. Right? That property specialist fund finds some brokers. Those brokers find some developers. Right? There's a hell of a lot of parties involved in that value chain. And that's just one example of many. So there are costs with those value chains. There are profits to be made. It's a market economy. But my mother doesn't see much of the returns or the value that end developer creates. So what if you just disrupt that, disintermediate everything, and say my mother can effectively put her $1 straight to the developer. That developer can add the value with that $1 and pay my mother a higher return. Caveat: capital at risk. Right? That's the model. So it's far more efficient, far more effective supply match that's effectively matching the supply and demand of capital to get people better returns. Now, ironically, we did that for many years in the UK with a perfect track record, never losing a penny of interest, never losing a penny of capital, average returns at about 8.14%, something like that. And now I get cold calls from major global asset managers. I got one cold call about 3 months ago was from KKR, very famous US fund, circa 200 billion under management, to say, we can't get that returns without security, can we participate? And suddenly you overlay the potential to have in your fractionalized model individuals, sophisticated investors, wholesale investors, and asset managers and financial institutions. And that's how that's evolved. And we have all of that. That brings diversity of capital. And diversity of capital brings consistency of supply. That's important to developers. And that, developers didn't really know that was important a number of years ago. When the pandemic hit, suddenly a load of financial institutions with single sources of wholesale capital said, could you pause? Right? And for a property developer midway through a project, a pause is as good as a forget the project, it's gone. Right? So diversity of capital brings that reliability. Now developers are asking that question as well, what's your source of capital? So who invests in marketplace lending? Well, this is really interesting because, again, this is a UK stats. So the people that are investing in marketplace lending, the individuals, and this is the open retail piece. In 2020, 67% of people by volume, by number of people, not by capital, because by capital that's 85%, right, are over 55. Right? By volume, by number of people. Okay? This is not kids punting on crypto. Right? This is people who place high priority on number one, preservation of wealth, right? And number two, maximizing returns. So, the security is absolutely critical, but the efficient matching of the supply and demand of capital serves that customer need brilliantly. And that was the opportunity. That's what's driven our growth. And we on the investor side, we put first mortgage behind everything. We're targeting 7% returns, and we're outperforming that and proving that over many years in the UK. We go through expert curation to make sure we're backing the best projects, and because of our proposition, we're attracting the best projects, so they want to be funded by us. We're a better source of funding. We're increasing the probability of success of their projects because we know, and we can talk their language and share experiences and support that process as a much better partner. And really interestingly diversified across many, many different projects. So the average diversification in the UK is about 70, 75 projects that people are in. Okay? And on a first mortgage, that risk management is exceptional. And that can be done directly or through self-managed super funds. And in Australia, we're open to sophisticated wholesale investors. So that's the two sides of the marketplace. And bringing those together is hard. It takes time. It's always balancing. Okay? But we've done that, proven that in the UK, and we're leveraging all of that expertise into driving that in Australia. And that's why we're recognised across the board, across financial services, across technology, across property, across growth businesses, tech businesses, etc. Widely acknowledged as a decorated business, and we're very proud of that. So wrapping up, that's what it's all about. If we serve small property developers better, who are underserved in the market, the economy is a better place. They build more houses and grow their businesses better, and we present investment opportunities to everyone. And that's powerful. And really behind it is actually Boris Johnson is a bit of a buffoon, I'm sure you realise in the news. But he has some smart moments. He came out early on in the pandemic and said, let's build. Okay? Because every home, at least this is the UK stat, every home that's built in the UK, average price across the UK is £300,000, but £100,000 of that is spent on labour, materials and services. Fundamentally important to the economy, not just the housing supply and affordability. And we can do this together and build a better future. And that's the sort of the ethos and values behind our business. Thank you very much.